Thank you so much, Enrico, and thanks a lot to Valerio for having me again at this truly beautiful place and at this exciting conference. So we now lived through Liberation Day, which was not liberating, but actually seems to have marked the end of global free trade. So what I would like to do in my short intervention is that I would start from where the euro area stands now and then discuss, as others did, where we should go from here. So let's just look back a little bit over what happened over the past 5 years. And so this shows you on the left-hand side the evolution of real GDP, on the right-hand side of inflation. And of course, you see the massive collapse of GDP at the beginning of the pandemic. Then we had a relatively quick recovery, but since then, growth has been rather sluggish. But it's important to stress we have not had a recession. And this is in spite of having faced a massive energy price shock when Russia invaded Ukraine. And we had a historically steep hiking cycle, which of course was a response to the surge in inflation that is shown on the right-hand side, with inflation moving up to a level of 10.6% in the euro area in October 2022. But then also inflation came down relatively quickly, partly due to our monetary policy, and it is now on track towards our 2% target. So I think it's fair to say that as of today, this looks like a soft landing. So the weak growth that we've seen over the past years is partly a structural phenomenon. So if you look at potential growth in the euro area, you can see that potential growth dropped quite sharply after the global financial crisis and has not really recovered. And in fact, as mentioned by others, the divergence in productivity growth with the US started even earlier, so in the 1990s. So what has happened? So one important aspect is that the competitive position of the euro area has weakened. So what you can see on the left-hand side is that there has been a steady decline in euro area export market shares, and of course this stands in a stark contrast to what has happened in China. So China's role in global trade has changed fundamentally, and in particular China has moved up the value chain and is now a main competitor to euro area countries in relatively advanced products. Of course, this is partly happening on the back of large state subsidies. One important factor for the competitiveness in the euro area have been energy prices. So energy prices are a drag on competitiveness, and this has been exacerbated quite a bit by the recent energy price shock. And I think it's interesting to see what happened to industrial production in the euro area if you distinguish the more and less energy intensive parts of industry. And you can see that the less energy intensive industry held up relatively well. Whereas the energy-intensive part of industry suffered a lot. Then, of course, as is also just mentioned by Joachim, we are facing headwinds from demographic change. We have rapidly aging societies leading to a shrinking working age population. And also possibly leading to a structural labor scarcity going forward. And you see that actually the situation is particularly dramatic in Italy. So now we are facing new shocks amid the structural challenges that we have already been facing. And this has led to a dramatic surge in uncertainty. So whatever uncertainty index you look at, geopolitical risk, global economic policy uncertainty, trade policy uncertainty, they have all risen dramatically. And actually in the most recent days also financial market volatility has gone up substantially. So there was, some people had the view that Liberation Day could be the day of peak uncertainty, but actually I'm not entirely sure that that is the case. So of course in the coming weeks we are going to look very carefully at what the most recent events, what they imply for short and medium term developments on growth and inflation. But one point I would like to make here is that if you take a somewhat longer term perspective and you think about shifting into a more fragmented world, then what is likely to happen is that this is going to be very harmful for economic activity, but also harmful for global inflation, thereby reversing many of the benefits that we've had of globalization. So what is the reason for inflationary pressures that could rise? It's the lower efficiency of supply chains, is the higher frequency of supply shocks, and a less elastic global demand. The current geopolitical situation has, of course, also increased security concerns in Europe, and this has led to this remarkable turnaround in Germany that was also discussed by Veronika this morning. So we've seen an easing of the German debt brake, something that I think none of us would have expected just a couple of months ago. So this is really quite remarkable, and on top, a very large infrastructure fund. And this comes after decades of low public investment, especially in Germany. And so, of course, it will be very interesting to see what effect this spending is going to have. And the literature shows that especially infrastructure spending can be expected to have significant growth effects, also because we can expect that there's going to be a crowding in of private investment, because public investment tends to be complementary to private investment. On the military spending, the literature shows that the multipliers are significantly smaller. However, this depends very much on how that money is spent. So how much of it is imports and how much of it is spent in a way, as mentioned by André, that generates technological spillovers. And I think if we think about kind of modern warfare, a lot of it is actually related to technologies. And so if this money is spent wisely, the multipliers can be significantly higher. Another important finding from the literature is that the fiscal multipliers tend to be highest when the economy is not doing well. And so this is important because especially the large fiscal spending in Germany, but also the additional defense spending in other countries could counter the negative growth effects of tariffs to a certain extent. But that also means that this spending has to happen relatively soon. Of course, there is also an issue related to public debt. Already before the recent spending initiatives, debt in the euro area was high, and interest rates are, of course, much higher than they were before the pandemic. So one has to expect that interest rate expenditures are going to go up significantly. And so in order to ensure debt sustainability going forward, there is actually very little alternative to fostering potential growth. So the increase in potential growth will be very important. And this is not just about spending money, it's also about structural reforms. And this is a clear imperative going forward. If we look how markets responded to the German announcement, actually we saw an increase in sovereign bond yields across the euro area, but interestingly this was more or less completely driven by an increase in real yields, whereas sovereign spreads, for example, they remained stable. So this means markets interpreted what happened in Germany as something that is positive for economic growth in Europe. And that was also confirmed by equity market developments. Of course, these charts would look very differently if I updated them today. So of course, the stock markets collapsed yesterday in particular. But the relative performance is still there. So the euro area and Germany in particular outperformed the US significantly over the past month. So how can we deliver on this kind of positive promise? As mentioned by many people during this conference, innovation is absolutely key. I mean, many people here have said that Europe is lagging behind and so on. So my impression is, and that's also confirmed by the left-hand side chart, which shows the number of patents, that of course we are not the leaders in those areas, but we are also not all that bad. We have many innovative companies. We have good founders. We have good ideas, and especially we have a relatively high number of patents in the area of green technology. So this is something that we can build on, and of course we have to become better. What is absolutely key is risk capital, the availability of risk capital. This is what is needed for innovation. And this is where the Savings and Investment Union clearly comes in. And I think we should have a strong focus there on the full value chain of risk capital from the startup phase, over the growth phase, to the exit phase, which then requires a liquid stock market. Of course, I cannot sit on a panel with Enrico without talking about the single market, and clearly the single market is one of the key solutions to the issues that we are facing. As mentioned by many others, the internal barriers remain too high, and this is especially true in services, where one could also almost say that we do not have a single market. So why is that so important? It's important because it allows firms to scale up. And the literature is very clear that firm size matters for productivity. So in the EU, 30% of all employees work in companies that have less than 10 employees. So this tells you how small European companies tend to be. So for me, one of the major initiatives that should be pushed forward with respect to the single market is the famous 28th regime, which for me is the only way to move forward in order to allow firms to scale up more quickly and more easily, rather than waiting for harmonizing insolvency law and many other things across 27 member states. Another important issue is financial integration, but actually our most recent numbers show that we are at least going in the right direction. As was mentioned by others, we are also facing new questions of national sovereignty. And what we see is that with regard to China, European firms have already started to implement de-risking strategies to become less reliant on critical inputs from China. And sovereignty also matters a lot in payments. So we are seeing that cash is losing in importance, which means that card payments become the dominant way of payments, and card payments are dominated by US-based providers. And this is why the digital euro is also important from a sovereignty perspective. So finally, the euro is the second largest reserve currency, and now is the perfect time to further strengthen the international role of the euro. And the most important thing that has to happen is that we need to create a more liquid EU bond market, so that the many investors who are now looking for alternatives to dollar investments find the opportunity in Europe. Let me close by saying that, of course, the EU was not born to screw the US, but it was born to make Europe thrive. And today it's an imperative to ensure that Europe is able to withstand the geopolitical headwinds, and the best response to the geopolitical shifts that we are experiencing is to make Europe stronger. Thank you very much.